guest believes we are in a secular bull market, and an investor with the right risk tolerance and the right time frame should be buying the dips. Eddie Ghabour, managing partner of Key Advisors Group, joins us now. So what do you think of a day like today? We're down. It was red everywhere. Is now a time that you should be buying? And what should you buy?
So I do think that we are in a secular bull market. Look, after the bounce we've had from the December lows on the 24th, I think an investor has to realize the market's not going to go straight up. So these little drops in the market are actually normal. And frankly, I think it is healthy for the market when you have this volatility, because it keeps scared investors away from the market. And that's usually very bullish because you don't have this euphoric state in the equity markets. And yes, overall, I think one of the best sectors coming into 2019 that we favored from a firm standpoint were the big banks. I think the banks were really oversold. One of the biggest worries with the banks were an inverted yield curve due to the Fed raising rates last year. But now that the Fed has kind of changed their tone and basically has said they're going to take a little bit more of a stance where they're going to wait and see in regards to economic data, we don't anticipate anything more than one rate hike for 2019. So that inverted yield curve is off the table in our opinion, and we think that the buying the banks going into this year was a contrarian play because they were oversold and they're really inexpensive from a valuation perspective. So I think you're going to see a rotation where maybe the banks are going to be one of the leaders for 2019.
Eddie, I would just ask, it feels like the market has gone straight up, though, since the beginning of this year. And so while we've seen a little bit of consolidation, we've had a couple of days where the market's off 1% in the last handful of trading days. I guess, how important is this earnings season for investors to get the bad news that was basically priced in at the end of last year past them? And then where does the market go from here? Because to me, a market that goes up 6% in 20 trading days or whatever it was, that's basically straight up. And so I guess the question then is, when we consolidate around, basically what's the 50, 100-day moving average, 2640, whatever you want to call it in the S&P, where does the market go from there? I mean, I guess, do you see it going higher? Do we get back towards those record highs that we saw really only 4 or 5 months ago?
I do think before the end of the year, now there's a caveat to this, if we get China trade deal taken care of, then I think the market hits new highs at some point in time in 2019. Now, I still believe the path to getting there is going to be very choppy. So I agree 100% with you. I think short term, the market's gotten a little ahead of itself because of the huge spike short term. So I would expect to see another drop, 3-4%. But again, I think the path for 19, if we get China done, is hitting new highs, because I think that's going to kind of relinquish some of the concerns that some of these big multinational companies have had. And I think you'll see growth spur in the second half of 2019 if we get that trade deal done. If we don't, I think the market has a lot of challenges in 19, but I'm cautiously optimistic trade is going to get done. Earnings will be okay for 2019, and we'll hit new highs because interest rates are going to stay low.
Hey, Eddie, so talking about interest rates staying low, we had the Fed meeting this week, kicks off tomorrow. We'll get the announcement on Wednesday. If we hear anything surprising in terms of the language in this statement, how are you hedging your bet, or how do you best protect your portfolio against something like that?
Well, I think the best thing for anyone to really do as far as hedging your bet when you're worried about news like this is, I don't think investors, no matter how bullish anyone should be wise to ever be fully invested in the equity markets. Because if you are, then you don't have any ammunition to buy the dips. So from a firm perspective, even though we've been very bullish over the last 3 years, we try to not put our clients in a position where they're taking too much risk. So I think it's very prudent to make sure that you have cash and you have fixed income in your portfolio as ammunition to be able to buy dips. Because if you're fully invested, I think you're putting yourself in a very vulnerable position when you're looking at the volatility that we've been experiencing.
Eddie Ghabour of Key Advisors Group, thank you so much for joining us.
Thank you for having me.